Good morning, everyone. How's it going? It is 6 a.m., half an hour before the market is going to open on Wednesday, August 14th. Now, the big report that we are waiting for, or at least the market was waiting for, was the CPI report. My feeling was that it was not going to be anything that significant, but just everything's baked into the market already. So it shouldn't really move the markets all that much. But we'll see. We'll see how it came out. Did it match expectations? Did it beat expectations? Was it worse than expectations? And how the market is moving because of it. So let's go ahead and take a look at our report. CPI. CPI year on year, prior was 3, consensus was 3, we got 2.9. Okay, so tiny bit lower, but within the consensus range, and really not progress for a year's worth of work. Just basically the exact same. X food and energy, 3.3, consensus was 3.2, and we got 3.2. So right on consensus. And again, just a tiny bit lower than a year before. So really not that much progress. So the market should be fairly neutral to this. Let's take a look at how we're reacting. So we got the S&P 500 initially popping a little bit up, then trading way down, then coming back up about even. So baby muted reaction to this, similar to what we saw in the PPI yesterday, but even more muted than yesterday. So anyone who is expecting the market to be highly reactive is, well, they're probably a little disappointed. People who are putting on straddles and strangles and things like this and really expecting the market to move, unfortunately, so far, at least at the open, we're not moving all that much. And it looks like we're leaning slightly to the positive side, but I wouldn't trust that. So let's take a look. Russell is traded up, then down, is still down. The Dow Jones flat, up, then down, then flat, maybe slightly up. And then the QQQ similar to the S&P. What we really want to look at is the bond reaction. So let's see. We have bonds right here. We traded way off and then still down. So trading down in prices means higher yields. So now the bond market is saying, well, we are probably now our chances of a September rate cut are just slightly lower. This isn't a huge reaction, so I wouldn't make too much of it. But we can see that we are now at least opening near where we opened yesterday. So basically undoing the move yesterday. So any optimism that we got from the PPI is now undone by the CPI, and we're just flat. So that supports everything that I was saying, how, we might move a little bit higher. We've got that MA50 in place, but really everything about this market has been telling us that we're choppy. Yes, for the past week and a half, we've been going basically straight up in our major indices, but limited range. We are bound by that MA50 and the MA200. We're nearing the top of it. We've got a little bit of enthusiasm this morning, even though all we did was get what we expected on the CPI. And is that enough to shoot us completely above the MA50? I don't think so. I could be wrong. I could be over or underestimating the enthusiasm in the market. There did seem, going into the CPI report, there was definitely a bias to go upwards, even though I saw a lot of straddles and strangles being put on in the market. There's also a lot of just call buying. So there was definitely a bias to the upside, and people may just behave irrationally and just keep trying to drive the market upwards. Either way, it's not great news, because what would this be? This would be like an 8 to 10 day high. 1, 2, 3, 4, 5, 6, 7, 8. Yeah, we would be approaching an 8 or 9 day high if we make another high today, and then potentially a break of that MA50. But a 10-day breakout is very, very, very weak. A 20-day breakout is very weak. There's statistically only about 30% of those might actually make it and continue on to new highs. So we would need a lot more development inside of this market for us to get comfortable that we could break these highs. And again, we had the same thing. If we start to get to these levels right here where we put on or we started to unwind that Japanese carry trade, while we're now approaching territories where it makes sense for institutions to continue to unwind. So the news is that Japan is going to keep on hiking rates for an indefinite amount of time, and eventually the US will be cutting rates. So it just makes sense for institutions that have that carry trade on to take opportunities, especially early on, to unwind. So my personal belief, my personal analysis points towards this not really making it too much higher. Maybe we could hit these levels up here, but I don't know. I'm already putting myself at risk because we're basically right at that MA50 or very close to that MA50. But I don't think we have much higher to go above this MA50. Similar to when I called this one right here, where I said we're not going to go above this level. What I said was 565, and we made it to 564.86. It's going to be another of those moments, it feels like. So I think we're pretty much done here. We could just chop sideways, but from what we saw earlier, that we have the potential for a very wide channel. We should take a look at VIX before we really form a strong opinion over how wide of this range can be. So let's take a quick look at VIX. VIX is still coming down. That's good news. We made it down below 19 finally, but we're still above 15. So we're not really going to consider ourselves under normal circumstances until we get below 15. You see right here, where's 15? That's right. I should just draw a line, 15. Okay. So how long? So this was the previous pullback, and then we lived beneath 15 and mostly around 12 to 13. And then we started to go up towards this previous correction now. Then, or actually not quite correction. Yeah, I think we hit correction territory. 9%, I think, is what we hit. So now we're starting to pull back. And so we're not going to be in these normal levels until we go below that 15, just like in this region before. The entire 2024, the entire end of 2023, we are below this 15 level, maybe one or two tiny little blips above it. And then, but except for pullbacks, then we were, or corrections, then we were completely below this 15 level. So that's what we want to see before we feel like we're resuming normalcy. So let's go and take a closer look at what our bond looks like. Moving upwards. Interesting. Okay, so it looks like bonds are still moving upwards over here, even though on an intraday basis, when we looked at it, yeah, the reaction was down. So overall, we're still above where we closed yesterday. Okay, so that's interesting. That tells me that the market is completely disagreeing with me. So we'll see. We'll take a look at the Fed watch tool. I don't know if it'll be updated yet. We may have to wait until after the market. So yesterday we were looking at over 50%. Yeah, over 50. One day ago, yeah, over 50% on the break 13th. Yeah, today's the 14th. Okay, so this already shifted. So we were talking about how this was over 50%. And all we might do is shift some of this back over here if we got disappointing CPI reports. And not that this was disappointing, this is basically right on target. So you can see how much the market was expecting to see a much better report similar to the PPI, because otherwise this would not have shifted back to the 25 basis point rate cut. Again, I'm still of a position that 80-90% chance of no rate cut in September. And the CPI report only firms that up because we don't have the data. The CPI is just basically the same as last year. So we haven't really made any progress in the last year. And the Fed already made the mistake of cutting or waiting to raise rates to combat inflation, the whole transitory for almost 2 years. They were saying it was transitory before they started to react. And now they want to make sure that they don't stop too early, because if inflation just flips back up and then they have to raise rates again, that would just be really, really embarrassing for them. So I don't think we're getting that September rate cut. It doesn't matter what everyone else says, this 100% conviction. I think they're in for a surprise. And just so you know, these guys have been wrong for the last couple of years also. Hey, we're going to get rate cuts in 2023. Hey, we're going to get rate cuts in June of 2023. We're going to get rate cuts in December of 2023. We're going to get rate cuts at the beginning of 2024. We're going to get rate cuts in February or in the summer of 2024. And here we are now saying that we're going to get rate cuts in September of 24. Eventually, they're going to be right. But I don't think it's going to be in September. Maybe sometime this year, but not September. Too early in September. So let's see. So our CPI is not enough of a boost to make us go significantly above that MA50. We might challenge it today. We might go a little bit above. This was a really big move. Considering, well, I guess I can't say that. The PPI report was a really big surprise. I should say it that way. And so we had this move right here, which was decent. It wasn't huge. It's about the same size of this bar, right? Size as this bar. So we did get a little bit of movement here. But what's really interesting is that volume that came in this buying was limited to just the moving average. It wasn't like this. This was institutions coming in after a huge sell-off and buying up everything that the retail traders wanted to sell. Institutions bought 1 billion. The retail traders sold 14 billion. Where did the other 13 billion go? It went into the hands of the market makers because if a whole bunch of people are selling and I don't have anyone else to match it to, well, that's the market maker's job to absorb that inventory. So institutions only took 1 billion of that. But look over here on this really good PPI report, just average, nothing like this, what we saw right here. So that's another sign to me that the market isn't, or at least institutions aren't super enthusiastic about taking this higher above that MA50. So we'll look at a limited upside range for today. Let's get some levels in here. So we've got that MA50 is going to be a challenge. Then we've got the 555 level. Why isn't this working? 555. Then to the downside, we got a little bit of support here at 530. 530-ish. Well, maybe a little higher, 535. Okay. And then if we break below 535 today, then we'll go down to 530. 530. There is some support there with that MA90, but I'll give it a little bit wider range. Go to 525. Okay. So those are levels that we're going to be looking for. Yeah, 525. Those are levels we'll be looking for today. So if we move upwards with strength and momentum, then by sometime next week, maybe we will hit that 555 level. But if not, we could chop around in here. That VIX is starting to come down. So we may not traverse all the way back down to that MA200. And realistically, we had that VWAP here anyway, so we wouldn't expect it to just drop down to the MA 200. We've got this magnet level, which is the same as the 150 right now, and then this annual VWAP number right here that we're more likely to pause at. But we could react to 525 as well. So not much else to look at. Did we look? I don't think we looked at 90-day highs in those yesterday. So 118, 17 or 77. So finally triple digits to the upside, but it's only in the hundreds. And this is nothing to get excited about. This is still indicating flat. And what we really, if we do 52-week highs, 79. Wait, what is, I need to look at this 24-week high. Interesting. So we've got, I really want to see my 20-day. Might have gotten rid of, oh, here we go, 20-day. 111.16. So it's the same as 90. So this is nothing really. So, and again, 20-day breakouts are weak. 10-day breakouts are weak. We actually expect them to fail. So what'll be interesting is actually looking at what is breaking out on the 20-day level and what is breaking out on the 90-day level. So on the 20-day level, Palantir, that is an AI stock. Starbucks is just off of news, so I'm not reading into that. Nike, very weak, poking up after this extended consolidation period after this drop here, which was probably earnings. Uber, Taiwan Semiconductor, Meta. So we got communications, we've got chips, we got some Chinese tech, we got a AstraZeneca, a drug company. So Keurig Dr. Pepper, this is a little bit different because this was a flat to uptrend and that's breaking up. Same with PPL. So these are a lot stronger than a 20-day breakout off of, say, like this Darling International, which was down and then we broke up in that 20. Or what was that other one that we saw? Was it Nike, right? Nike down and then we break up. That's very weak. So we've got some of the larger healthcare stocks. So which is interesting to note because the healthcare sector was one of the ones that we were more comfortable with. But if all they're doing is 20-day breakouts, AbbVie actually looks healthy because that is a nice uptrend and then breaking out of a 20-day high. The Eli Lilly is not as strong, but it doesn't look like Nike. But we've got tech stocks over here like that Palantir and First Solar it's included in XLK. I don't know why. Cloudflare, Net, see 20-day high off of a downtrend. So these are not that strong. And then on our 90-day highs, which are much higher conviction, so these will be about 60% to 65% successful on their breakouts. We've got things like, well, also AstraZeneca, but this is again nice uptrend. And then Keurig Dr. Pepper, Altria, these are a lot more staple type of stocks. So basically everything is saying don't go full risk on yet. So in other words, the way I've been saying is portfolio should still be neutral. And we're not going to get optimistic or bullish until we get above that 50 and then above that 555 level. Okay. So we got a good idea of what we're thinking. We probably have a limited upside. So just watch that very carefully and have a great rest of your day. I'll see you in the aftermarket, which I might be a little bit late to. So I'll send out an announcement if I might start it at 1:30 instead of 1. Otherwise, we'll have it at 1 o'clock. All right. Have a wonderful rest of your day and I'll see you a little later.